Today I wanted to go ahead. We've been talking about credit. We've talked about savings. I want to talk about get into what we call asset building now. And when we talk about asset building tonight, I really want to talk about the largest asset that most people have, and the probably the not probably the asset that determines net worth, and those who, in a sense, have significant net worth, and those who don't, and that's home ownership. And it's really key because if you think about what's just happened over the last 2 years during this pandemic, we've had a significant number of people who financially have struggled or have lost their job, and we're now dealing with high inflation. But also during this time, individuals who own homes have seen their net worth, basically net worth being assets minus liabilities, shoot up significantly. Some of it was due, of course, and those who own stocks and investments saw some of that. But home ownership and those who own homes many have seen their houses grow 50, 80, 100, 200,000 in value over the last 2 to 3 years. So some people who bought 5 years ago may find that they now have $300,000 in equity. And so the gap between those who own a home and have equity, and I'll tonight talk about what is equity, because I want to add some words to our vocabulary. What is equity? How do we build equity, whether it's in a home, whether it's in a small business, what is it? But that gap now in terms of wealth has grown dramatically between homeowners and non-homeowners, homeowners and renters. So I want to talk today and talk about home ownership and just kind of lay the foundation. This is not an in-depth discussion, but it's to get you familiar with some terms that you may see and come across, and hopefully encourage some people to begin to or add to their list of things that financial goals. Home ownership, it may be a medium-term goal of 3 to 5 years. It could be a long-term goal of 7 to 10 years or shorter. It really depends on the individual and their financial circumstance. But I want you to understand how valuable and how critical it is in terms of building generational wealth. So I'm going to go ahead and share my screen. All right, Sheba, if you could go ahead and give me the capability to share.
I would do that. Give me 1 second.
Okay.
Because I forgot about this part. We're going to make you the. Oh, you should be good.
All right. Yep, there we go. All right. So I'm going to start with home ownership and go through that. And then I have another slide presentation after that. So let's start with home ownership. I want to start with some basic understanding of some terms. So we're going to talk about the benefits of home ownership, types of mortgage loans, the monthly mortgage payment. Not going to go too much into credit. We covered that on the first day. And then I want to show you how home ownership impacts the overall wealth or net worth of an individual. So when we talk about home ownership, we're talking about the ability to build equity, and that is the amount of the home you actually own. So let me explain that. If I own a house that is worth 400,000, but I owe 200,000, my equity in that house is 200,000. The value of the house minus what I owe to the bank has a portion of ownership in that, leaves the $200,000 in equity that belongs to me. Paying rent does not build equity, but I always correct that. I say it does build equity. It builds equity for the landlord. Every month that you pay rent, whether you're renting a house or apartment, that landlord, that individual, if they have a mortgage, will take that payment or portion of your payment and someone else's and pay their mortgage, paying down their mortgage to build more equity. And chances are, like most real estate, over time, it's going to grow in value. So the challenge is that for individuals who rent for 20, 30 years, and let's say they've averaged paying $2,000 a month in a matter of 24 months, 12 months, you're going to spend $24,000 over the course of 30 years of renting at $24,000. You're going to be have spent well over $750,000 or so in rent and have no equity, nothing to show for it in terms of value. So owning a home increases wealth. How we define financial wealth? Well, it's assets minus liabilities. So in other words, if my house is worth 400,000 and my other assets are 100,000, so I have 500,000 in assets. And if my liabilities are 300,000, then 500 minus 300 leaves me a net worth of 200,000. So when you hear that someone is a millionaire or a billionaire, it means that their assets exceed their liabilities by $1 million or $1 billion or multiple billions of dollars. Okay. And so we also want to talk about the tax benefits for mortgage interest deduction, because the government does offer a tax benefit. So a person who pays a $2,000 mortgage gets to deduct the taxes and the interest of that payment. So a portion of that $2,000 goes in taxes, a portion goes in interest, and that is able to be deducted off of their tax return, where someone who pays $2,000 to rent doesn't get to deduct any of that payment. And then there are people who buy 2 to 4 family homes so they can collect tenant rent and increase their income, assuming that the rentals exceed the monthly mortgage payment. Now that becomes a source of income. Or I've seen it where somebody will have a 4-family property, live in one of the properties, and use the other 3 to pay the mortgage, and therefore they're able to live rent free in that property. So basically, the other 3 individuals pay the mortgage, and so they don't have any mortgage or rent to pay, and they can therefore save what they would normally pay in rent or mortgage. So, and last of all, a house is a place to call your own. You're able to decide how you want it to look, or what you want it to look like. It's a place to gather family, build memories, and it gives a sense and pride of ownership that renting does not. Okay. So just a couple other terms I want to make you familiar with. We're talking about a conventional fixed rate. That is the most common type of rate that is offered. A lot of times it's 30 years. Some people go with a 15, but the most common rate is a fixed 30-year. And that's a great rate or a great product for a homeowner, because that means the interest rate is locked in and fixed for 30 years. Okay. So that means if you got a rate of 3.5%, that rate is not going to change for 30 years. Okay. That rate is locked in. All right. Then you have adjustable rate mortgages. Some people like adjustable rates because they start off generally lower than a fixed rate, but you do run the risk of, as rates go up, that rate will go up. So people who have had adjustable rate mortgages recently, as the Federal Reserve has been raising rates and mortgage rates have gone up from the high 2s now to the 5% range, have been seeing their adjustable rate mortgages go up. And many of them are probably looking to lock in, because even a 0.5% or 1/4% rise in your mortgage rate is dramatic. When you're talking about thousands of dollars a month, you can be talking about several $100s if your rate jumps 0.5 point or 3/4 of a point. And then we have government-backed loans, FHA, VA. These are loans that are designed oftentimes, or that work to help people get into a mortgage or into a house, because the down payment, especially if you're coming from not having a property, a lot of times what it takes for you to put down to be able to the down payment for a home is very significant, and many people aren't able to save that much, because a lot of times a lender may require 10 or 20% down, and it's very difficult, especially as mortgage prices go up, or housing prices go up. A $350,000 home, if you have to put 20% down, that's $70,000. Very difficult for people to save that much, and that doesn't include closing costs. But if you have a FHA loan that's at 3%, now you're talking about something in which you can get into that property. 3% times 400,000 or 350 is now talking about 11,500. Way different. And for some VA loans, it's 0%. So again, these government-backed loans allow individuals, particularly first-time homeowners. And my wife and I went many years ago when we bought our first home. After having rented for a couple of years, we used an FHA loan to get into it, because we could just barely save up enough for the down payment and the closing cost, and we're able to use an FHA loan to start it. So one of the things I also want you to understand is, with a mortgage, mortgages are a little different in terms of the monthly payment than most other loans. Most other loans, whether they're student loans, car loans, just installment loans, that you're just doing, or even credit cards, you have principal and interest. So there's a portion that goes towards the principal. The principal is the amount you borrowed, and then the interest is the charge that the lender is is the amount the lender is charging you for using their money. But in the case of a mortgage, you have principal, interest, taxes, and insurance. Okay. The taxes and insurance are held in what's called escrow. Escrow just means one party holding the funds for another party. So the lender, the taxes and insurance don't belong to them. Okay, the taxes belong to the municipality. So in the case of the District of Columbia, let's use that. DC levies the taxes on the properties in the district. In Prince George's County, where I live in Maryland, Prince George's County levies the taxes, but they don't collect them. The mortgage company collects it, holds it, and then when the bill is due, they go ahead and pay it or pay the taxes. Same thing with the insurance. The bank wants to make sure that there is insurance on the property, that homeowners insurance protects their asset. Remember, when you first start buying, when you first buy a house, the majority of the house belongs to the bank. You may have put 5, 10, even 15% down, but 85% of that is the bank's money. And of course, they want homeowners insurance. If something should happen catastrophic to the house, they want to make sure that there's someone that is going to fix it. I'm going to stop here for a second. Any questions on anything I've talked about so far with regard to mortgages, building equity, PITI as it's called, principal, interest, taxes, and insurance, and escrowing payments? Any questions so far? All right, hearing none, I'll continue. And then you have private mortgage insurance. That's used where if you don't put down a certain amount, generally 20%, a bank or lender will require that you get private mortgage insurance that protects their loan if you default. Okay, so these are the aspects that make up that mortgage payment. So when someone says they have a $2,000 payment, all $2,000 is paid to the lender, but the lender does not keep all $2,000. A certain portion of that is escrowed, kept in a separate account, okay, and is specifically designated to pay the taxes and the insurance when those bills come due. Okay, I won't go into credit too much because we've talked about credit before, but credit is very critical anytime you're looking to buy a house. It is a large purchase, so your credit will be scrutinized. So if you are beginning to think about some point you want to own a home, one of the first places you want to start with is your credit. Asking yourself, is my credit in the point where I have a great likelihood or better likelihood to be approved and also get one of the best rates? Because even a quarter or a half point difference on a mortgage can make a significant difference in your monthly payment. So one of the things you want to do is, as we mentioned in the first presentation, is you want to work towards having a 700 score. We talked about the 700 club, getting your score into the 720, 740, 750, so that you can not only have a greater likelihood of being approved, but also be in a situation where you can get the best rate possible. Okay, so again, working on your credit, getting either Credit Karma or Credit Wise, downloading the apps, seeing what your credit score is, and then working systematically to improve your credit. Or if you already have good credit, maintaining it so it makes it easy, that much easier when you apply for a mortgage. You know there's a high likelihood you'll be approved. All right. So again, we're not going to go too much into the credit score. Your credit score can impact your rate, and the rate helps determine your affordability. These items, judgments, liens, collections, bankruptcies, foreclosures, will stay on your record for 7 years. So first of all, we want to avoid getting them. But if they are on there, know that, again, these are items that can be an impediment to you being approved for a mortgage, because from the lender's eyes, these are major negative items, and they will also weigh down your overall credit score. We also talked about before ways to improve your credit, besides making, of course, your payments on time, staying under 30%. You also can get a secured card or a credit builder loan so that you have new information reporting saying that you're paying on time. That will help your score grow faster. And I already mentioned the credit tracking tools. CreditWise, which is a Capital One product. You don't have to be a Capital One customer to use it. And Credit Karma. These are products that you can use to track your credit score and also give you information about what steps you need to do to improve your credit. Again, I said it before, I'll say it again. Never pay someone to help you fix your credit, okay? All of the information that we've shared over these last several weeks about credit, and even again today, you have the knowledge, you have the understanding, you have the apps that give you and tell you what you need to work on. No need to pay somebody to do something you can do yourself. All right. And last but not least, there are many money management applications available for free or online for your smartphone. So a lot of times people have trouble saving, or they say, I don't know where my money's going. It just seems like money's just going into a bucket with a hole at the bottom. So there are a lot of different apps that can help you, manage your money, know where your money's going. If you're a person, some people like using a simple spreadsheet and listing out all of their expenses. There's apps such as Every Dollar and Mint that help in terms of you budgeting and saying, okay, putting money in different categories and seeing where you're spending money. The whole goal of tracking the money is to make sure that you're making your money work for you, that you are putting aside a certain amount of funds that you are earmarking for your savings, for your investing, and also making sure you're not overspending in certain areas, okay? So what are the steps in terms of if I want to become mortgage ready? Well, as we talked about before, you want to request and review your credit. Okay, that's something you should be doing whether you want to be mortgage ready or not. In the first session, we talked about how it's not just lenders like mortgage lenders that look at your credit. We talked about how jobs pull credit, many of them do. Landlords pull credit. Cell phone companies use credit if they're going to finance a cell phone. And we talked about how insurance companies use credit. So even outside of a mortgage, you have a lot of people that will take a look at your credit, and depending on what your credit score is, it can either help or hinder your plans to get a job, get an apartment, get inexpensive insurance, and ultimately, of course, purchase a home. Okay. Start saving for a down payment, whatever your goal is. If you haven't been saving, start a goal of $5 or $10. Yes, that's not going to be enough to buy a house, but at least get in the habit of savings. Set a goal based on your budget of saying I can save $25, $50, $75 per paycheck. Have it come out up top, go into a separate savings account and begin saving. And then as you find that saving that amount becomes easier and easier, you get an increase in salary, you paid off some other debt, then increase the amount that you're having automatically go into your savings account. Highly recommend setting up an auto transfer or payroll deduction where it goes in and you don't have to think about it. And review debt and create a household budget. The debt to income ratio, which we're going to talk about next, I want to talk to you about that because debt to income ratio is the thing that lenders look at, one of the ratios that lenders look at, not just only for a mortgage, but for any type of loan before they approve it. So understanding how the debt to income ratio works, what goes into it, and how can you improve your debt to income ratio is key, not just for buying a home, but getting approved for any other type of loan. And then meeting with a home counselor, someone from a first-time home buyers program, which I highly recommend if you're a first-time home buyer, so you can get information on any grants or loans or assistance to help with down payment, because the down payment is often the biggest sticking point for people who are buying their first home. Many of them can pay the monthly mortgage that they would have, and some may even be paying more than that in rent, but the challenge becomes coming up with the down payment that's required by the lender and having enough money to pay that, but also still having some money in your savings account. And also, of course, paying for closing costs. Anytime you buy real estate, there's closing costs. And those can be significant, 7 to 8 to 9% potentially of the cost of what you're buying. So you can be, of your overall expenses. So you could have closing costs of $5,000, $6,000, $7,000 on top of the down payment. Okay. So let's talk about the debt to income ratio. And I want to teach this because the debt to income ratio or capacity is the second biggest reason that people are declined. Number one is credit. But the second biggest reason is that they're overly indebted. So lenders look at this ratio to see, does this person have too much debt, or do they have sufficient cash flow, enough cash coming in minus their expenses to cover not only their current debt, but the new debt that they're asking for. So the first thing is mortgage, your monthly rent or mortgage payment with taxes and insurance. So that goes at the top. So first thing you want to do is look and say, how much am I paying each month? Or what is my future payments going to be? How much are they asking me to pay on a monthly basis? Okay, so the lender's going to plug that figure in here. Okay, what is the new monthly mortgage payment going to be? And if it does include, if there are homeowners association, those will be included as well. Okay, then any monthly payments for credit cards, the minimum due, not what you actually pay. So in other words, if it's you're $1,000 on a credit card and it has a $25 minimum, you would put 25 in here. If you have 3 cards, one has a $25 minimum, another 50, another 60. that'd be 135. You would list 135 as your monthly payments here. Then any monthly loan payments, so that's cars, personal loans, student loans, all of those go here, and you total up all of your monthly debt. These are all of the monthly expenses that are generally found on your credit report that you have to pay monthly, from your rent and mortgage to your credit cards and to your loan payments. And then you add all that together, get your total monthly debt, and then you divide that total monthly debt by your gross monthly income. Okay, so for example, if my annual income is 60,000, most people know their annual, you divide that by 12, and so now you have that my gross monthly income is $5,000 per month. So I divide my total monthly debt by my gross monthly income. I come up with my DTI, or debt to income. Okay, generally they want the debt to income somewhere about 35, 38% for a mortgage. They like it around that area. Okay, and you can tell if your DTI is getting up into this 50, 60, 65% range, that's pretty high. And that says you don't have a lot of disposable income. Most of your income is being eaten up by debts, because you have, of course, taxes and other things that have to come out of your gross monthly income. So I'm going to stop here. Any questions before I move into the other information that I have? Any questions about mortgages, buying a house, building equity? How does equity grow? All of that. All right.
I got a question.
Sure, go ahead.
I remember working with somebody, and like, how does student loans like factor into it? I know it's something weird about student loans, but like, how does student loans factor into the mortgage process?
Well, they're no different than any other loan. They'll look at what you have to pay, what your monthly payment is, and based on that monthly payment, that will be included. So assuming you're making a monthly payment on your student loan, just like a car loan, just like your credit cards, where it has loans, that amount will be plugged in as a monthly payment that you have. Now, if your loans are deferred, sometimes lenders may take a calculation of like 1% to calculate what you'll have to pay, because they know at some point during that mortgage, you will have to probably start paying on that student loan. So even though it might be deferred and you don't have to make a payment right now, they know at some point you will have to make a payment. So, they want you to, they want to factor in what is your debt to income going to be when you start having to make those mortgage payments.
Okay.
Okay, great question. Any other questions?
And is there a possibility that if you have rolled in your monthly credit card payments is there a way to incorporate that in your mortgage payment so you can pay a lower amount when you have credit card debt?
You can't do that when you're talking about like when you're initially purchasing a property.
No, sir. When you if you have, if you are, before you try to purchase a property,
Mm-hmm.
is there a way to incorporate, like, can you take out a home equity line that has a little bit less percent interest than the credit cards and get a better credit rating because of that?
Well, it's not going to give you a better credit rating, but let me ask you this. When you say take out a home equity line, you have to have the home to take out a home equity. So you're talking about before you buy the house?
All right, I'm sorry. If this is not your first house, I'm just looking if you already have a mortgage.
Gotcha. Okay, so you already have a house and you're looking to buy a second home as an investment property, or you're going to sell your house and buy a new home and use the equity in your current home?
Actually, either one. Would it be of benefit to roll in your credit card debt using a home equity line?
To answer your question, it can be. So for example, and that's a really good question, Barbara. Let's say I decide to go ahead, I have a house and I have significant equity. Now, of course, anything I roll in, I'm decreasing the equity in my house. So if I roll in $8,000 in credit cards, I'm decreasing the equity. But where it could be of a benefit, Barbara, is let's say I take out a $25,000 home equity line, or let's say of 30,000, okay? And I have $8,000 in credit card debt, or let's $7,000 in credit card debt, okay? But those credit cards, that 7,000 is at 50% of my credit limit on one, 45% on another, and so it's dragging down my credit score, then yes, if I roll that into a credit line, a home equity line, and bring those down to zero, and so now my credit usage has dropped from 45, 50% and 40% down to zero, then yes, my score will see a bump if by rolling in that credit line, I now go ahead and pay down or pay off those credit cards so that they're below 30%. The one thing I do have to be concerned about, it's not going to be huge, it's less than the bump you're going to get, is I do have a new loan on there. And so that, based on the age of the loan, may drop my score a little. But I hope I'm understanding and answering your question. If you do that and you bring it under 30%, yes, that will allow you to see a significant potential increase. If that line of that home equity one, you don't want to exceed the 30% on the home equity either, because remember, it is a revolving, kind of similar to a credit card. So if I have a $30,000 home equity and I put 15,000, I'm at 50% revolving. And just like a credit card, that can have a negative impact. Does that make sense?
Yes, it does. It makes exact sense. Perfect.
But if I take it and I'm not above 30%, but I use it to bring my credit cards under 30%, the same thing, Barbara, can be done if you just took a home equity loan, a flat loan, not a line of credit, because the home equity comes in two things: a home equity line of credit, which is revolving like a credit card, and a loan. Let's say I have 3 credit cards and they're all maxed out, because let's pick and say we helped out my child or helped out my parent. And we're like, my gosh, my credit's taking a hit. If I take a $25,000 or $20,000 home equity loan, pay all of those down to zero, okay, I'm going to see my score bump up, because now I've gone from whatever the percent I'd gotten on all of those. I've eaten up some of my equity in the house. So there's a drawback. I've used up 20,000 of equity. So there's less there when I sell it, to roll over and put as a down payment. But I can see an increase in my score because now I brought all of those credit usages under 30%, potentially under 10%. And in some cases, if it's enough, paid them all off.
Right. Okay, good. That helps me. Thank you.
All right, fantastic. Always glad to be of help. Please keep the questions coming. Any questions you have. All right, so I'm going to just hit you with one other thing, and like I said, and then I'll open up for any final questions. This is just a little slide that I've seen that I want to kind of share so that people understand. Again, this is not just to do with mortgages. This is any type of lending. This is how lenders or a banker looks at making a loan, okay? And this is called what we call the 5 C's of credit. The first C is character or credit. In a lender's mind, character is synonymous with how have you paid back your debts in the past, okay? Have you paid each and every debt back month after month? If you've done that, in a lender's mind, you have good character. You signed an agreement, you paid it as agreed, okay? So your credit score is the first thing that lenders look at, and it's the #1 reason loans get declined. Capacity is the #2 reason, and that's what we talked about, your debt to income. How much debt do you have relative to your income when you're looking to qualify for a mortgage or you're looking to qualify for a loan? They want to see how much debt you have versus how much income you have, okay? So you could have somebody that makes significantly less income than someone else, but if they have even less debt, they may be very good on this capacity, and that's what happens. Sometimes people make significant income, and yet they also have significant debt. And so they get tripped up on this capacity because they have a high debt to income ratio, okay? Next is capital. This is the money you own or investing in your business, or basically it's also what you have as your net worth. So this is your checking, your savings, your mutual funds, all of your assets minus your liabilities. How strong are you financially? Okay, how much strength do you have financially to sell and liquidate some assets and pay off the debt if need be? Collateral, that has to do with depending on if the loan is a collateral loan or not. Okay, so in the case of a mortgage, there is a collateral. Okay, the house is the collateral. In the case of a car loan, the car is the collateral. In the case of a credit card, though, most credit cards, with the exception of secured cards, do not have any collateral. So a collateralized loan, generally a lender will you can get better rates, and it's less risky for the lender in many instances because there is collateral. There's something to take if the individual does not pay back the loan. And the other thing that most lenders know is that people will pay a collateralized loan first before they will pay an uncollateralized loan, or what we call unsecured loan, because they don't want to get that item taken. So what do I mean? If I've got only enough to make the payment on my car loan or my 3 credit cards, generally I'm going to pay my car loan, okay? And I'll find a way to pay the credit cards, or I'll let them lapse, because I'd rather make sure my car's paid for and that won't get repossessed. And then last but not least, the 5th of the 5 conditions is called conditions, or what are the market conditions that are out there when you're headed towards a recession, or the economy is tough. Lenders tighten their lending criteria. They don't lend as freely. Okay, they want a higher credit score. They want a lower debt to income ratio. Okay, when the economy is going well, they loosen the credit standards, because they see there are very few people filing for bankruptcy, more people are employed, the economy is going up, people's wages are going up. So depending on the market conditions can determine whether or not somebody who might have been on the bubble or on the fence leaning towards approval in a time when the economy is going well may find that that same bank or that same institution now declines them when they're in a more difficult scenario financially, not just them, but the overall economy. The lender has raised their standard requirements for borrowing, okay? Now, this next graph is very confusing, and I'm going to explain it. But I love this as a graph because it explains the housing component of net worth, okay? Again, net worth is your assets minus your liabilities, okay? And just want to show you from an income perspective, the difference between individuals who are homeowners and those who are renters with regard to their net worth, to show you how much of a value a home makes on the net worth. So for individuals under 26,000, if they're a whole owner, an owner of a home, their net worth is 102,500. If they're a renter, it's 1,500. So their assets minus their liabilities is 1,500 versus 102,500 for the homeowner. Okay. Now, when we come to people making between $26,000 and $46,000, the homeowner has a net worth of 140,500 and the renter 5,900. If you look at this box right here, the brown is the portion of their net worth that belongs to the home. The blue is their other assets. So that could be checking, savings, investments, 401k, all their other assets. You can't see it here, but there's a little box. That's the renter's net worth. That's kind of right here on the bottom. And that's the 5,900. When we get up into 46,000 to 74,000, the owner has a net worth of 190, almost 191, the renter $11,000. And as again, you can see that the home is the majority of that net worth. Same thing here for 74 to 127, same thing here for 127 to 192. Okay, in this case, the owners would have a net worth of 433,000 and a renter a net worth of 116,600. Okay, now when we get to this last one, you see here that over 192,000, the owner has a net worth of 1.6 million, while the renter has 704,000. But this bar is the only one that's unique compared to the other ones. If you notice that the blue portion of this is greater than the brown portion. So it's when you get to people making over 192,000, okay, that you actually have non-home assets, assets outside the home make up the largest portion compared to their net worth versus the home. This green bar here is that of renters. A renter has a net worth of $704,000 versus the 1.6 million for the owner. But I do want you to note that the owner's net worth is now, the home is not the majority of their net worth. Other assets make that up. And so I'm going to stop sharing and I'm going to throw the question out to, I see we have Yeshiva joined us. When you look at that graph, what do you think those other assets are? That's the one time, what do you think those other assets are that have now surpassed the house when you come to someone who's making over, it could be an individual or a couple making over 192,000. What do you think that other assets are made up of?
Rental property.
Nah, that'd still be real estate. It's not rental property.
Real estate at all. Stocks.
Exactly. Think about it. A person who's generally making that kind of income is generally also older. They've worked a while. And so their 401k, their retirement accounts are probably now much bigger as well. So that's somebody who may have been, you know, in the workforce for 30 years. They own their house, and their house might have a net worth a certain amount, but they've probably built up their 401k, exactly, Barbara, their retirement accounts, their individual investments. Chances are that, along with some other assets, savings, and some other things, now make up a bigger portion of their overall net worth than the house. The house is still a large portion of it, but chances are now they have, I would guess that the majority of those other assets are probably stocks, bonds, mutual funds that are housed either inside of a retirement account like a 401k, IRA, rollover IRA, or outside of that in just individual investments. That's probably what that is. And the reason I just bring that up is what I want people to see is, if you make it a goal to, one, buy a house, invest in a 401k, your retirement, you know, at your job, or 403b, and do those things consistently, you have a great chance of ultimately being a millionaire, growing your assets over time. Now, time is the biggest factor, and that's why I always tell young people, the sooner you start, the better. But if you do those two things, you have a great chance of building a net worth that's over $1 million. Okay, you have a great chance because the house is going to appreciate and equity is going to be built there. And then the stocks, bonds, mutual funds, if they do what they've always historically done over the course of 25, 30 years in the workforce, you're also going to have significant assets and net worth there. Okay. Any questions about anything that I've covered today with regard to home ownership, mortgages, net worth? Any questions about anything we've covered, even back with regard to credit? We did touch a little bit on credit. Any questions on that? Everyone's good? All right. Well, that's it in terms of, like I said, I just want to kind of give you an overview. Hopefully this information is helpful to you in terms of understanding how to build wealth, the importance of building wealth through home ownership, but really just consistency. That's the main thing. By having a house, paying on a mortgage, and the natural appreciation that comes, individuals are able to build significant wealth over time. So if there are no other questions, Sheba, I'm going to turn it back over to you.
Y'all know I don't have any questions this evening, but I appreciate you, Sean. Thank you, Barbara, Yeshiva. I don't know if Martiz got caught in the storm. I know he said it was up in his area in Greene County. So thank y'all for showing up. And if there's no other questions, we will give y'all 15 minutes back.
Thank you. Take care.
Good evening.